Good morning, good afternoon, good evening, whenever you're watching this. Welcome to session 2 of the Mechanical Forex Trading Foundations program. So, here in session 2, I'll be taking you straight to risk management, and it's important that we cover this next so you understand that Forex is not as risky as the media or the other people paint it to be. Most people just don't know how to manage their risk. So in session 1, I talked about probability and edges. So here I'll expand on it a little bit so that you really tie it together with risk management and you understand what it means. So I talked about probability and we said that it's the likelihood of something happening or not happening. Right, and I also talked about risk to reward. So every edge has a win rate and every edge has an average risk to reward, meaning that, let me call it a strategy, right? So every strategy has a win rate, and every strategy has an average risk to reward. It means that over a space of 100 trades, or space of 200, or space of 1,000 trades, you'll be able to see that maybe your strategy has a win rate of maybe 50%, or 60%, or even 70%. But this by itself is not good or bad. Some people's strategy even have a win rate of 40%. What finally tells you whether it's a good win rate or not is your risk to reward. With a 50% win rate, the moment your average risk to reward is 1:2, you have an edge already. Because you multiply 50 times 2, it means that over 100 trades, if you lose 50% means you lose 50, you win 50, right? 50% means that of the 50 that you would win, each of them has a value of 2. So 50 times 2 is 100. So you are still in profit. With a 60% win rate from 1:1, like even if your average risk to reward is 1:1, you already have an edge. Although it's not going to be that profitable in the sense that it might not be that big, but you're already profitable. So 70% win rate, 1:1 works safe. But you see 40% win rate, 40% win rate will need at least a 1:3, at least an average risk to reward of 1:3 for it to be profitable, because 40 times 3 is 120, meaning that over 100 trades you would lose 60 and you win 40, but the 40 you'd win will have a value of 120. So by the time you minus 120 from the 60 that you lost, you're still in profit of 60. Do you understand? Yes. So your edge is actually a, like, let's divide the formula for edge. Your edge will be win rate times average risk to reward. If it's above 50, then your profit. What am I saying? Wait, win rate times average risk to reward, right? Equals to your edge. So if your win rate is like 50% and your average risk to reward is 1:2, you're in profit. Now let me show you. Anytime it is less than 1, that's when you know you're not profitable, or that's when you know it's not an edge at all. So let me give you an example. Let's say your win rate is 50%, and then your average risk to reward is 1:0.5. Meaning that for every trade that you win, the value is 0.5. Like, 0.5 is half. So 50 times 0.5 would be 25, right? 50 times 0.5, 50 times 0.5 is equals to 25. Now, remember, 50% win rate, you're winning 50, you're losing 50. So now the one you're losing 50 is greater than what you're winning, which is 25, meaning it's not an edge. Come on. So win rate times risk to reward, if it is greater than your loss, then it's an edge. If it is not greater than your loss, then it's not an edge. Let me tell you why I'm telling you this thing. It will make more sense later, but let's keep this in your head for now. So I talked about probability. Now, probability arranges itself in random ways. This is the only randomness in Forex. Every other thing is not random. The only thing that is random is probability. Let me explain. So, if you have a probability of 50%, right? Over 10 trades, you on average are supposed to lose 5 wins, 5 losses on average. Now, the thing is, you can never know how these 5 wins or 5 losses will arrange themselves. It's called permutation and combination. It can arrange itself as win, loss, win, meaning like first trade you win, second trade you lose, like that. Win, loss, 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 till it fulfills its probability of 50%, right? Another way it can arrange itself is loss, 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 win, win. Are you seeing it? Loss, loss, win, 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 win. 5, right? So another way you can also arrange yourself, you can start with a win streak, win, 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 and then to switch to losses, loss, 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 but you are still in profit. So this is where the psychological or the emotional effect comes in. If you do not follow the mechanical route where you have gathered a lot of data on your system, by the time you begin to experience the losses associated with your system, because every system, every edge, every strategy has losses, by the time you begin to encounter the losses associated with your system, you will not be able to keep applying it without having emotional breakdowns, because you have not seen it play out before. You feel like, oh, this is not working, I'm switching. And the moment you begin to switch, you've entered into a cycle of doom. And that is the doom that discretionary trading brings to trading, because you just saw the strategy and feel like, oh, you tried only 2 times, it worked. Now you went to a live market and started to apply it. God bless you, you started winning. The moment you begin to start to lose, you say, this is not working, I have to change something. Once you start to change something, that's the end for you. For the next 1-2 years, you'll be in a cycle of doom until you can sit your ass down and follow the mechanical framework where you will gather data on that system. Because if you gather data on a system for like 4 months or 3 months, and you have seen that your average risk to reward is, let's say, 1:3, I mean, that's 3R, and then your average win rate is 60%, you know that over a space of 10 trades, for example, you have you're going to win 4, you're going to win 6, and you're going to lose 4. So you're going to win 6 and lose 4, right? Now, you also know that each of your wins carry a value of 3. So ultimately, 6 times 3 is going to be 18. Your win is going to carry a value of 18, while your losses will carry a value of 4. 18 is bigger than 4. 18 minus 4, that is what? 14%. You're still in profit. But now, let's say you have not tested this system, and the same system that works so, and you start trading it. The first trade is a loss, second trade is a loss, third trade is a loss, fourth trade is a loss. Guess what? You are already flabbergasted. You're already losing it psychologically. You cannot continue with it because you are not a crazy person. Now, there are few crazy gamblers that can do this, but you cannot, because you're a logical person. Now, listen up. But if you have done your due diligence, what I'm teaching you how to do, the moment you begin to see these losses, you know that every system has losses. And this is why risk management is important. Can you hear me? So that when these losses begin to come, it will not have a significant effect on your account. Can you hear me? This is also why it's not advisable for you to go live with very tiny amounts of money, because if really you're not, if you don't really don't have a very strong edge, by the time your losses start to come, because the money is so small, you can't risk properly, that account will be blown. Some people say, I blown account. They're saying $5 account, $10 account, $25 account. Those are small things, really small things. But some of us have studied so deeply that we can even take a $10 account and risk $1 per trade, because we've mastered the use of lower time frames. But beginners may not be able to do that because of the fast-paced environment. Do you understand? So now you've encountered your 4 losses. Now, because you have a discretionary mind, you feel like, this is not working. I've changed. You will change something, and you've entered another cycle of doom. The moment you change something in strategy, you've gotten a completely new strategy, and you've reset your probability cycle. So imagine that new change that you made. Let's say you even increase the win rate to 70%, but you still have 3 losses, and then the 3 losses still arrange themselves like back to back. You feel like, it's not working. You change something again. This is the cycle of doom that keeps people unprofitable for years. So you need to be able to see, like, you have no business going live if you don't have an edge. I've said it countless times. And if, for example, after I finish training, you come and meet me, that you blow an account and I ask you, do you have an edge? You say no, you are not my student. I will block you on all platforms and you have no business coming back to me. Because unless you have an edge, you have no business going live. Unless you've mastered risk management, you have no business depositing any amount of money into your account and going live. That's the truth. Nobody will tell you this. Say that, oh, you cannot do it because you are not a demon. It's a logical something. You have to learn it. So now, after your losses have arranged themselves, your wins can begin to arrange themselves. And if you never stayed with that system long enough, you would never see the wins. Do you understand? And the same way this thing arranged like this, you can also arrange it like this: win, loss, win, loss, win, loss. That's how many now? One, two, three, win, loss. That's the four losses have they're complete now. You can have win, 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 win. That's how it arranges itself. And every system that is profitable has losses involved. That's what I'm telling you. That the only thing random in trading is the arrangement of probability. But guess what? That's not your business. Your own is just to execute the system. Whether it's a win or a loss, it doesn't matter because you've done your due diligence. You know it is profitable in the end. So after everything, after all 10 trades, after let's say after an entire month, guess what? You're still gonna be in profit, you're still gonna make your money and you're still gonna make your withdrawals. But you just have to sit down and stick with the system. That is your job as a trader. It's not to make money, it's not to win trades. Your job is to execute an edge flawlessly. Your job, listen to put write these things in your brain. Your job as a trader is to execute your system flawlessly. That's why people use robots. That's why Wall Street they invest heavy amounts to create HFTs. These are high frequency trading machines that can help them to execute the system flawlessly. There will always be losses, but because these are machines, they don't have emotion, they don't have psychology. They know that their job is to execute a system flawlessly, and then they do it so good and so well that they always provide like profitable results for their owners. But I don't like robots personally because I feel like if something goes wrong, you have no one to blame. But when I trade myself, because I personally like to trade actually, I can hold myself responsible if I do something wrong, and I feel like trading actually builds you as a person. It strengthens your psychology and your emotions, and this is the mechanical aspect of trading. Discretionary trading is a poison because they will never tell you this. Mechanical forex, I'm telling you, if you can't follow me, your trading will not take you 6 months before you begin to see crazy results. As if you're going on your own. If you're working with me, it's a lot faster. Now that's for probability and that's for edges. I hope it's clear that this is the only thing random in the market. The fact that probability arranges itself in random ways. But even though it's in random ways, it will still fall back to its actually base, which is 60%, 50%, 40%, 70%, whichever your strategy carries. And different strategies carry different risk to rewards and different win rates. You understand? So win rate basically is self-explanatory. Is the amount of times or the percentage of wins you have over your losses. While your average risk to reward is the average value of your wins divided by the average value of your losses. I said something. RR is average value of wins divided by average value of losses. These are the things that will run the operating system of your trader, of the trader inside of you. These are the things that must be in your mind. You should never forget these things. Now, let's talk about risk management properly. Now, for someone who knows, you know that your average risk to reward, your average win rate is 40%, right? And your average win rate, let's say you're very good and it's 1:5, or let's put 1:3, meaning 120. Yeah. So you know that let's say in every 10 trades, listen, no, in every 10 trade, you will lose 6 on average, and you win 4, even though your your risk to reward will like make it profitable at the end, right? Now listen up. So if you know that you will lose 6, and let's say you have $10, for example, let's say you have $10 and you have the ability to risk $1 per trade, how much would you read? How much would you risk per trade? If you are not a mad person, listen up. If you are a logical person, how much will you risk per trade when you know that you can lose 6, and these 6 trades sorry, can arrange themselves in like they can come back to back. So if you are a foolish person, you go and risk $2 per trade. right? You're gonna lose $2 per trade. You're gonna and that's 20% of your $10 account, which is absolute madness. Usually, the safe spot is 1% of your account, 2% of your account. Then, depending on your win rate and your risk to reward, you can go up even up to 5%, and that's the maximum you should go to. Do you understand? That's why I say you should not go live if you don't have an edge. You should know these things before you even begin to before you place your first trade on prop account. That's on funded accounts, prop firm accounts. You don't even want to go past 1%. People go. See, I know people that I personally even do 0.5% of my account. 0.5%. That's half of 1%. Some people, my mentors, they reach 0.25% because they are trading on $1 million account. So 1% of $1 million account is $10,000, right? Right. Now 0.25 is like $10,000 divided by 4, and that's what 25. So they're risking $2,500 on a $1 million account because it's enough for them. Let's say those ones, I'll get to that shortly. Back to what I was saying. So you know that your win rate is 40% and you have a $10 account, Abby, and then you foolishly decided to go and risk $2 per trade. Now, what if your losses decide to arrange themselves like this: 1, 2, 3, 4, 5, 6, and your wins arrange themselves like this: 1, 2, 3, 4? Guess what? You blow your account, and it's nobody's fault. It's your fault. 1, 2, 3, 4, 5, 6, because $2 times 6 losses is $12. You've already blown the account. But if you're smart, you will know that you're supposed to at least risk 1%. That's like, so you haven't make yourself safe. You can put it on 0.5%. But 1%, or sorry, $1, when the 6 losses happen, you'll be down $6. You still have your $4 that will help you make your wins. So when you have your 4 wins, remember each one is valued at 3%. So 4 wins times 3 is equal to what? $12. So you started with 10, and after 10 trades, you're up $12. You've made how much? How much on your account? You made 20%. There's still profit. Now, let me give you another example. You have $100, right? And you know that's why it must be that's why it's very important for you to know. You know that your system has a win rate of 70%, right? And an average risk to reward of, sorry, I didn't write it well, of 70%, and an average risk to reward, that's average RR, of, let's say, 1:2. Now mine is like 1:5 above, but anyways, of 1:2. Now listen up. You have $100. You know that, let's say, over 100 trades. Listen up. Over 100 trades, you will lose 30, and you would, on average, you would win 70, right? To make 100, or 30 plus 70 is 100. Now, how many percent? How many dollars will you risk on this account? If you decide to risk, listen. Now, $1 on $100 account is going to be 1%. Fair enough. $10 is going to be 10%. Now, if you foolishly decide to risk $10 on this account over 100 trades, what if your 30 losses arrange themselves back to back? What happened to you? You blow your account. You will blow it, because 10 times 30 is equal to 300. You have already blown the account already. You've blown it, right? But if you drop that risk to $5, for example, you have still blown the account. Because what if your losses arrange themselves back to back? Always ask yourself that question. 30 equals to what? Equals to 150. You have still blown the account. Now you keep dropping it till you find a good spot. So a good place to start will be 2%. Because if you lose, if your 30 trades, if your 30 losses arrange themselves back to back, which is very unlikely to happen, but it happens, then guess what? You've lost only 60. Now with the 40 left, still risking that same $2. Now, this is fair enough. You can risk $2, 2% on this part with this particular win rate and with this particular risk to reward. So that means that when you take your $2 and you lose 30 back to back, you have lost 60, you still have $40 left on that account. Now once your wins begin to come, $2 times 70 wins, and each of them has a value of 2. What would that be? 2 times 70 first of all is 140. 140 times 2 is what? 280. Now you're going to make 280. Now if you minus 280 from, if you minus 60 from 280, which was your losses, minus 60 equals to what? You still be in profit of $220, and you started with $100. Now you're up 220, and you're in profit, risking 2%. So what I'm saying is, you basically need to know your win rate and your risk to reward first before you even decide on the amount you want to risk on an account. Because if you do not know this, you're going to blow account non-stop. I'm telling you. Now let's move to problem accounts, where you have like $10,000 accounts or $5,000 accounts. Here they are asking you just to make 10%. Like, personally, my monthly goal is to make 12.5% on a funny account, right? And then their maximum loss on the account is 8%. Meaning if you lose up to 8%, the account is gone. They'll fund you $10,000 to trade, and whatever you make, you split it with them 90% or 85%, right? But they have a maximum loss 8%. If you lose 8% on that account is gone, right? But if you make 12.5%, for example, whatever the amount is, you split it with them 90%. Now, on a $10,000 account, I'm not even going to bother calculating it. I'm just telling you that on average, just risk 1% or 0.5%. Because guess what? Your losses can arrange themselves in any way. So let's say you have 10 trades, for example, and using that same 40% win rate example, 40% win rate example, 40% win rate example, and your average risk to reward is 1:3. Oh God. Listen to this and it change your life. Listen very closely. You have 10 trades, right? For example, 10 trades. It means that 60 out of 10 trades, 6 is going to be losses, 4 is going to be wins, right? 6 losses, 4 wins. 6 losses, 4 wins. Now listen very closely. If you are risking 1% and your losses arrange themselves back to back, it means that you're going to have 6 losses back to back. 1% is going to take you down 6%. Can you hear me? It's going to take you down 6%. So if from there your wins pick up from 6% back up. Now listen. So 10 trades, you have 6 losses back to back. You have lost how much? 6%. You are so close to the maximum loss, maximum drawdown on that account. Now from 6%, now you have to start building, because your wins are going to come, and each win is worth 3. So 4 times 3 is what? 120. So 4 times 3 is 12. I mean, 4 times 3 is 12%. Now listen up. So 12%, remember you have lost 6% before. So after you've lost your first 6%, by the time you make your 12% from your wins, you're going to be in profit of 6% because you minus it. Now you're back in profit, right? So you're very close to hitting your maximum, your whatever for the your goal for the month. But even if you don't hit it, 6% of $10,000 account is already $600, and you can make a withdrawal. But they'll take a little split from it, and that's it. Now, so that means 1% is an okay risk for this account. But now let's erase this. Let me leave the go and that one. Let's say you are foolish, you are very foolish, and then you go and risk 2% of your account, right? 2% of $10,000 is what? Is $200. Abi? Yeah, $200. 2% of $10,000 is $200. Now, very good. So you know that your win rate is 40% and your average risk to reward is 103, and you still go and reach $200 per trade. I know you can have 6 losses back to back. So 6 losses times $200 is equals to what? Let me use the percentage for you. Is equals to what? 12%. Guess what? You have already passed maximum loss. You have lost the account. It's gone. Now you see, the problem here is people look at the upside, they don't look at the downside. They say, okay, if I raise this amount, means I can make more. You can make more, but you can also lose more. Have sense. You need to be smart in this business. It's not gambling. It's a business of probability. So you need to know how to arrange your probability in a way that's profitable for you. That's why you have an edge. You have to be smart here. So meaning that the only good risk for you on this account with your particular win rate and your risk to reward is 1% or 0.5% for maximum profitability. Do you understand? With this risk percentage, you can never lose this account. You can never, because your win rate and your risk to reward will never allow you to lose this account. That's how it is. But let's say you are blessed and you're good and you follow me and you have like a win rate of 70% and an average risk to reward of 103. For example, for example, now let's say you know that over 10 trades, you're gonna lose three and you're gonna win 7, right? And you know, remember, maximum drawdown on this account is 8%. Let's say you're risking 1%. If you're risking 1%, it means that over 10 trades, you will lose three. But then your losses will pick up and then you begin to win. 7 wins times, let me just do that. 7 wins times your 1%, but your average win is carries a value of 3, which your risk to reward. And that is equals to what? 7 times 1 is 7, 7 times 3 is 21. So you'll be up to 1%. You're in profit. You can make your withdrawal. You're good. So 1% is good. Let's try 2%. 2%. So if you lose 3 times with 2%, you're already down minus 6%. That's very close to maximum drawdown. Meaning 2% is the maximum you can risk on this account with your particular win rate and risk to reward. This you know. Now if you risk that 2%, 7, first of all, your 3 losses. Okay, I've already calculated it. Your 3 losses is going to give you, look at it here. Your 3 losses is going to give you 6% in drawdown. You are very close to hitting the maximum drawdown. Now, from that place, if your wins begin to arrange themselves back to back as well, because your losses have already finished arranging themselves. So 7 wins times 2%, and each one carries a value of 3. Remember, your losses carry a value of 1, your wins carry a value of 3. That's why it's called 1/3 risk to reward. What would this be? 7 times 2 is already 14. 14 times 3 is, what's 14 times 3? 14 times, I have a calculator here. No vex one. 14 times 3 is 42. Oh, that's actually 7 times 6. My bad. 14 times 3 is 42. Guess what? You're in massive profit, but you have to minus your loss. So 42 minus 6, that's 38. That's correct. 34, sorry. Maybe 36. 36 or 30. Yeah, 36, 36, 36. So 42 minus 6%, sorry about that, for that breaking transmission, equals to 36. So you're up 36%. Right? So this, you need to understand this thing, that you can decide whether you're going to be profitable or not from the start. You can decide whether you're going to lose money or not from the start, just by understanding your win rate and your average risk to reward. And you will learn all of these things, how to calculate, how to test and calculate all these things, and know them before you even begin to risk any amount of money. Now imagine you make 36% on a $10,000. That is $3,600. That's $3,600. That's 36% of $10,000. $3,600. And if you take a 90% split, that's very small money. That's meaning 10% of this, which is $360. So jazz will be $360, while you will take the remaining 240. So your split from here, jazz split will be $360, because they're taking 10%. If it's a 90% split, they're going to take $360. Yours is going to be 24, right? Let's see, 240. 24. Sorry, yours is going to be 3,000, 3,240. That will be your split. Now 3,240 in this economy, which when Nigerian naira is 17. How much is that? 3,000. You said no food down, so don't judge me. 3,240 times 17. That's 5.5 million in 1 month. You see this? But no, people want to follow the gambling, the exciting discretionary. That's why you're just placing trades anyhow. You will lose and lose and lose, and you lose your mind. You go crazy. Because you guys, some of you are beginners, you're just starting now. You have not seen madness. You think you have seen hardship. You have not seen it. Forex will destroy your life if you are following that discretionary route. But if you can sit down and calm down, funny enough, people think that mechanical actually takes, it doesn't take more time. It takes less time. But it takes away the excitement of placing. These are what casinos use when you are doing slots, all those bright numbers, all those flashy. People like those things. But that is the way that leads to hell. That is the way that leads to destruction. Because you are saying flashy. You should sit down on your charts, study, gather data, and know your win rate, know your risk to reward. If it's not good, you change something, test it again before you attempt to put any money. That way, you're a smart person, and because you've seen the result of this particular system, that's how you build confidence. I say this thing that confidence is a byproduct of preparation. You have a public speaking event. If you prepare crazily, there's no way you will stutter because you're prepared crazily. That's the same way it works in Forex. And that's for risk management. I've taught you something. Please never forget it in your life because you're going to use it forever as long as you're a trader. And let's move to position size calculation. Now listen very closely. Position size calculation. For those of you who are advanced and you've never learned this thing like this, now I pray and I hope you've learned it. And see, if you can apply this one, first of all, your life has already changed. For those of you who are advanced, probably they didn't teach you this. That's why you are still struggling after 17 years of trading. It's not your fault. It was your fault, child, because how can you be? Anyways, thank God you met me. So we're going to talk about position size calculation before we even talk about different type of orders, and I'll take you to my MT5 or do any of those things. Very good. So position size calculation, very nice. So position size basically means we are talking about lot size. I'm talking about lot size here. Lot, why is it on the line itself? Lot size. I'm talking about your stop loss, talking about your take profit. You see all of these things live just now, take profit and all of that. So now listen very closely. We're still using the $10,000 account as an example, right? Or let's even use your $100 account. Let me first tell you something first. There are different types of lot size. You have 0.01 up until 50, 70. I'll explain what these things mean just now. People have names for this. They call it micro lot, mini lot, standard lot. So this is what you call a micro lot. Micro lot. 0.1 is what you call a mini. People have different names for this thing, so it's not really, just know what it is. But and then 1 and above is what you call a what? Standard lot. Right? Listen very closely. Very closely. So there's a particular way they teach this thing where they'll tell you that 0.1 carries a value of XYZ. 0.1 carries the value of X. So carries, I don't want to teach you like that. I want to teach you with this formula. So now, how to know the lot size to see? Your lot size should never beat. People tell you that you should use one lot constant. You don't do that because your stop losses are not the same. You get to that. We get to the chart shortly and you see it. Each trade will have a different stop loss. And remember, I will say we measure price in pips, right? Measure price in pips. Your stop loss is going to be in pips. Your tip are going to be in pips as well, right? So listen, write this down. Your stop loss is never going to be the same. Hardly will it be the same. Therefore, your lot sizes should not be the same because you want to keep your risk consistent, not your lot consistent. Keep the risk percentage consistent, not lot size consistent. All these things have to be in your brain before I show you live. All these things have to be in your brain before I show you actually. Now here's how to calculate it. Let's say on a $100 account, you are risking 2%, for example. Now you know that for every trade till the account increases to like, okay, let me show you something very crazy here. This is what we call compound gain. As the account increases, you can now begin to increase. See, your 2% stays consistent, but because the account is increasing, 2% automatically will increase as well. And also, when the account is reducing, 2% will be reducing too. So you see, $100 is there, 2% must be consistent. When the account, for example, increased to 150%, or let's say $200 now, your risk is still 2%, but it has increased. 2% on $100 was $2. 2% on $200 is now going to be $4. This is how you can gradually grow an account, but your percent must be 2%. Now listen, let me clean this. So 2% on a $100 account is actually $2. So you know that you're risking $2 on this particular trade, right? Now listen very closely. Yes, say your stop loss is 10 pips. Now this is the formula. Now remember I said there's pips and there's pipettes, and pipette is the small brother of pips, and 1 pip is equals to 10 pipettes, meaning 10 pips is equals to what? 100 pipettes, right? So when you're calculating your lot size, you are going to use pipette. This is what it looks like. So the formula is this. You already know that you are risking $2, so your risk, right, divided by pipette. Very simple formula. So if you are risking $2, you know that, let's say for example your stop loss is 10 pips, automatically meaning that your pipette is going to be 100. So you're going to divide 2 by 100. When divide 2 by 100, what's the answer? 0.02. That's your lot size. Let's say you take another trade and the stop loss is 15 pips. Very simple. Your risk, see, we write this thing, we tattoo it inside your brain. Tattoo inside your brain. $2 divided by what? 150 pipettes, because it's 15 pips. 15 pips equals to 150 pipettes. You can never go wrong with this calculation, this strategy. You don't have to use any external calculator. It's in your brain. $2 divided by 150. About use calculator if you're not have it done. 2 divided by 150. 0.01. So there's no 0.013. So you know that your lot size is 0.01. So even if your lot size is what? Even if your stop loss is 20 pips, for example, let's know 20 pips, for example, your stop loss is 20 pips, meaning your pipette is going to be 200. So when you're calculating it, it's going to be what? 0.01. Now this is why you cannot use certain amount of money to trade certain strategies. If you're following people like Forex who trade on a 4-hour time frame and their stop loss is like 74 pips, how do you want to use your $100 account to trade a 74 pips trade? Except your win rate is very high and you want to risk higher. Really, for example, let's say you have seen $5 now, and the stop loss is 50 pips, for example. 50 pips, for example. That means your pipette is going to be what? 500. Because you are risking $5, you can still use your 0.01 lot size. But let's say you don't have that kind of money and you deposit $25 and you're risking, say you want to risk only $1 per trade. $1 per trade divided by that 500 pipettes, you cannot take that trade. So you need to find a style that fits the amount of money you have, because not every amount of money can take certain trades. Personally, based on experience and years, I literally have stop losses of 5 pips, 10, maximum 15. Usually doesn't go, it ranges between 5 and 15. That place 5, 15, let's say even get to 20. That's by far the worst case scenario, because I trade on EU, just Euro USD, for example. So $1 and you have a 50 pip stop loss. What's the answer? 1 divided by 500. 0.002. It does not exist. The only place you see stop loss lot sizes like this is in synthetics. Aside of that, it doesn't exist. So you can't even take that trade because the stop loss is too wide. That's why they'll say that you need, like, depending on your strategy and how big your stop loss is. These are also things that you see in your testing. From your testing, you will see how big your stop losses are. Then you know the amount of the kind of account you can use to trade this kind of strategy, right? But my own personal style, I don't have stop losses that this big. So if you're following me, you're good. Do you understand? So this is how to calculate position size. This is what we call lot size. So write this formula down in your brain. Tattoo it there. Never forget it. Lot size is equals to risk divided by pipette, not pips. Pipette, not pips. Before you go and use lot size that is bigger than your account. Pipette, not pips. Never forget it. Now, let's move to types of orders, and I'm going to go to my MT5 shortly. So types of orders, let me just go to my MT5 and just show you there. Before I go there, let me just show you. You have your normal market execution of buy and sell, execution of buy and sell. Okay, let me pause this and open the demo account quickly. So if you go to your MetaTrader 5 and on the top left you see like three dots, and then you click on it, you see a plus button, and once you press that plus button you'll be here. And literally search for any broker you want to create a demo account straight from MT5. So for this example, I just want to use meta quotes. I know I told you guys to use derive. Sorry, that's a derive. I didn't say derive. I said Hantech, Xness, or Hot Forex, right? So right now, for this example, I just want to use meta quotes because you can easily just get a demo account right there. Click on create a demo account, you can put in your details and blah blah blah. You'll be good. Let me. Okay, the demo account has been created and I deposited $10,000 inside. Remember, it's a demo account, not a real account, right? Okay, I'm just quickly going to show you the different executions and possibly just use it as a run through of all the features of the MetaTrader 5 app, right? So the first is the instant market execution, buy and sell. Those are the first two things that we're going to talk about, right? So first things first is your MT5 app, and hopefully if you've been following, you probably have everything. So let me move this. No, stay there. Let me move this guy a little bit. Stop moving. Thank you. Okay, great. Now this is your MT5 app. So at the bottom here, we're starting from the bottom. I'm going to start from this bottom. So the first on this bottom here, which is quotes, you have all the pairs that are actually on your watch list. This is called your watch list. This is called what? Your watch list. And if you are a beginner, I want you to delete literally everything and leave just one pair or two on your watch list, Euro USD. So I'm going to explain what you have on this place. So basically, this is, I've told you about base currency and quote currency. So EURUSD is the base, USD is the quote currency, right? So you see this thing here, this thing, this 4 that they wrote there, that's your spread. That's the spread, and spread is the difference between the ask price and the bid price on the chart. Let me show you. Look at the difference between, let me go to the 1 minute time frame, for example. So let me zoom it in. The difference between these two prices that you're seeing right now, this red and this blue, or yeah, red and green, ask and bid, that's your spread. So that's the profit margin that your broker makes on every single trade that you take. Whether you lose or you win, they always make a profit. So anytime you execute a trade, it's never executed on the exact price you executed. There's usually a shift, and that small shift is the spread. So if, for example, you try to like take a sell here, based on spread, it may drop, it may go a little bit higher, so it may drop a little bit lower, and that's where your sell start to count from. And the same way, that same spread can affect your stop loss. So if, for example, your stop loss was here and this price may have not got into your actual stop loss, but just a few pips to your stop loss, it will hit it because of spread. So one thing we should always do with spread is always add extra pips to your stop loss just because of spread. So now back to this quote section. Now this 5 here is your spread, and then the time, this thing there, that's the time. That's the time. You can see 7:25:36 based on the time they are using. I don't know why it's 7, but it's like 1 hour ahead of, that's the time on the particular pair or the broker, right? And then this is the actual current price of Euro USD based on this particular broker. And the first one is your ask price, second one is your bid price, right? And the difference between these two is the spread. So if you look at the difference between 9 and 4, so that is always moving. So just look at it quickly and you can quickly tell the difference, and that will be your spread. But you don't have to calculate it yourself because they have automatically calculated it for you and they've put it there as 4. Then this other two things here, low and high. So low and high, that's like the lowest price of the day, highest price of the day. So don't have to bother yourself. So back down here, the next button here is the charts. So here on this chart screen, you have everything from the prices. You can actually zoom and zoom out, zoom and zoom out. Like you can do a lot of things here, right? And this is also where I'll be showing you different order types. And if you click on this button, this one right here, this thing, sorry, this button is what I'm trying to show you. This one, this last button here. If you click on this button, that instant buy and sell option will go away. So if I click on it, you see it shows the sell and buy, shows the seller, it's gone, right? So also this right here is a crosshair. that we can use to like measure price. For those asking how to measure pips, you can use to measure your pips. Just put one hand on where you want to measure from. For example, if you want to measure from this high to this low, I just have to put my two fingers on the screen and it's measuring for me. So right now it's showing me 40, and that 40 is what? Pipette, not pips. It is 40 pipettes, and that's equals to what? 4 pips. You understand? If I drag it down, you see that it's showing 19. This 19 is actually 19 candles, while the other one on the right is 123, which is 123 pipettes, which is equals to what? 12.3 pips. I understand already. So that's your crosshair. And then the next one, this is next button there is for indicators. If you are someone that uses indicators, just come in here and you can click on the button and you see any indicator you want to put on your chart, and you have indicators right there. You can also delete and edit the indicators you have on your chart with that option. Then the next one there is your time frame. That's this one right there. That's your time frame button. So click on it and you'll be able to switch between 1 minute, 2 minutes, 3 minutes. I'm so proud of MT5 for actually adding all these extra time frames. And if you click on this still on time frame button, click on this settings at the right, you can decide to remove the time frames you want to be seeing or add ones you're not seeing based on the one you use for your particular trading, right? And that's that. Then moving on to this one. This is for actually setting pending orders, and I'll show you what that is shortly. So this is a demo account and I want to show you the difference between different kind of orders and different, you understand. So before I do that, let me quickly show you these last two buttons here, which is this one and this one, and then this one. You don't really need them like that. So the next one, the trade button, is where you see your current balance, you see your equity, and you see your free margin. So if I was in a trade, it will be showing in this place, and I'll show you that shortly. Also, you can also add an order with this button right here. Yes, you can actually do that, but I'll show you all of this things shortly. Then history is where all the trades you've taken will show. If you're using the meta code server, that's where you'd see your messages. So right, let me go back to the chart options and quickly show you what an instant order is. I'm going to jump to the 2 minute time frame just so I kind of get current live market price. So if, for example, I wanted to instantly buy this market at this point in time, I would click on, let me show you. I told you that this is the button that shows us the instant buy or sell button, right? That's the instant buy and sell. And I told you that anytime you want to enter a trade, you must calculate your stop loss first. So for example, I want to buy here, you have to be very fast with it. So I can quickly calculate that my pips here is 3 pips, right? 3 pips, or let me say, yeah, 3 pips. And if I add like spread, my stop loss would be like 35. Obviously, and based on the price already moving, let's say 40 everything overall. So quickly you have to now calculate your stop loss. If, for example, you want to risk $5, you quickly calculate it. But based on if you actually trading, you're a lot faster than this. $5 divided by 40, and your lot size will be what? 0.125. So basically, you just increase your write the lot size as 0.125. And why is it not letting me take it by with that? What's wrong? Is it too high or too low? What's happen? What is this rubbish? I can't take it trade with 0.1205. Oh, I know why. Because they don't allow 3 decimal points. Oh, no problem. So that's basically so 0.12. And although that's not what I wanted to buy before, but because of their stupid mistake. So boom. So that's an instant buy. The moment you click on buy, if, for example, they showed you the option to accept a particular see what I said just now, that I wanted to buy here. At the time when I pressed that buy, price was like here, but then it executed and it came here. That's your spread. That's the spread that the broker always adds. So you must always put in place your spread. So now that my this thing has been, I can tap on this buy order and I can click on this right here. I can click on this right here and my stop loss shows, and I can move it to where I wanted to put it, which was around 40 pips here. And if you see, I said I wanted to risk $5, I can see at the left the amount is showing me is around $5, right? So that's how you make sure that anytime you're taking a trade, you always click on modify and it will change it. You always have the exact same risk that you want. So now you're in the trade, you took an instant buy, right? And you set your stop loss. Now for a buy, your stop loss will always be below your buy order, and for a sell, your stop loss will always be above the sell order. So now as you've bought, now if price continues to go up, you'll be in profit. Now let me show you from the trade screen. Now remember, this trade was taken without any form of analysis. It was just taken just for an example, so you don't expect it to be in profit. So for example, it's in a profit of $2 right now, and you can see that I told you that if that this particular trade screen, it shows you the trades you're actually in, shows you the lot size you're using, shows you the amount of money you're currently making, right? And then shows you the price you entered in and the price, that price that price is currently at, right? And then also shows you your equity margin, free margin, blah 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 blah, and all of that, which I'll not explain here. I'll explain somewhere else. Then this button at the top right, you can use to change the order in which the trades you are in shows. So this one can also use to take instant execution. That's this button right here. This one at the top right. You can also use it to take more trades. That one right there. So if you click on it and you want to add more buys, you can do that as well. So that's for an instant buy. Now if we go back into the chart and want to take an instant sell, the same button by the left, and let's say without any analysis, let me tell I want my stop loss to be like somewhere here, which is like, I'll calculate it quickly, that I want a, okay, my stop loss will be somewhere here, so 60 pips. So if you're calculating and risking $5, just quickly go to your calculator and calculate it. $5 divided by 60, or 60 pips rather, that's 0.08. That will be your lot size. So you can sell, but put your this in at 0.08. Great, and you can sell instantly. And that, let's say that you've done your analysis and you want to sell, so you can quickly check and tap on it, and you can hit stop loss and take your stop loss there, which was around $5, around 60 pips, 60 points rather. So sometimes they call another name for pipettes is points, right? So 60, and you see that is around $5 as my risk, right? So if price hits my stop loss, it will be that. And that's basically instant execution buy, instant execution sell. The same way your take profits for the buy, you can quickly just hit the buy button. You see TP will show at the bottom. Tap TP, you can move it to where your take profit was supposed to be at. And depending on your analysis, the amount will change depending on wherever it is, right? So your take profit for a buy order will be above the buy order, and your stop loss will be below the buy order. Now for this sell, whose stop loss is here, remember your take profit will be below the sell order, and you can hit take profit too, and to show, you can now set it wherever you want to set it. So since I was risking $5, I want my top loss, my take profit to be at least $5 as well, and that's what you call a 1 ratio, a 1 ratio to reward. Great. So now we're in a buy and we're in a sell at the same time. Just for an example that I wanted to show you, please don't trade like this. It's called hedging. So that's it. That's for the example. Now I'm going to show you pending orders. Now I can close these two trades from this screen. I can simply just either hold it and you see close position, right? Or I can slide to the right and you see the exact same options. For another thing you can do is, if you want to close all your trades once, you can either close it one by one, or you can do what we call bulk operations and close up all positions at once. You understand? Boom, and everything will close. Everything will close. This one too will close, but it's server that's holding it. I think to close up position, yes, and I was wrong with you. But anyways, if you did not close, just close it with loss, and boom, reject, accept, done. Great. So now I've closed it and we didn't really close in a loss. We actually, you can check your history, you can see both trades were closed in a profit. One was closed at a profit of 0.64, that's 64 cents, and another was closed as break even 00. Now great, let me show you pending order now. Now a pending order is one you set when you don't want to enter immediately, but you want price to get somewhere first before you enter the trade. For example, now I told you this is the button you will use for pending order, that one right there. When you click on it, you see different orders will show. Now let's say I want a buy limit is an order you set under current price, so below current price. You want price to get there, and if price gets there, it will tap you in and then you continue your buy. So you can calculate your stop loss, and let's say you want to risk probably with this same lot size of 0.04. Let's say I want to risk $2 on this particular trade, but then I know that my stop loss point is, let me quickly set it. Boom, place fast. Okay, great. So I set it already. And let's say I wanted price to come this low before tapping me in, right? And you see that price has touched it, but it has not activated yet simply because of spread. But the moment the ask price got there, now it has activated, and now we're in the buy already. Now your stop loss is here. You can move your stop loss or reduce it if it was wrong before, but you cannot change your lot size because you're already in the trade. You understand? Great. Now that's a buy limit. For a sell limit, at the top, same top right button, second one, you can tap on this and you see sell limit. I'm sorry, so you have to take it to the upside because it has to be above price for sell limit to show. Now sell limits can be set above price because you're expecting price to rise there first for tapping into that particular order and then selling. That's the only way it will activate. So that's a sell limit. So you're not entering market instantly. You want price to get to a price which is above price first before um triggering into the trade and then dropping to your desired point. Same way you can put your stop loss and tap on stop loss and just move it to where you want your stop loss to be, right? And then you can also set your take profit, and your take profit also will be below price because you are selling. So let's say somewhere your take profit has ready to be. Then for the buy limit just now, which is already triggered, let me set a take profit for it at the stop right here. Let me put it up a little bit. Boom. So I've set two orders, the buy limit and the sell limit. The buy limit has been triggered because I set it before price got to the point. You saw it happen live, right? So both of them are active right now, and the buy is already in a loss. It's basically just a random trade. You understand? Right? So this is how you can control the amount of money you are risking on each particular trade. You know, people that tell you that I just invested in forex, they just took all my money. That's a big lie. They seriously do not understand risk management at all. I can literally have just $10 and decide that I'll take 10 trades with that $10, risking $1 per trade on every single trade, and the money would be enough if you know how to do that kind of trading. I can basically because I give very small stop losses. You understand? So that's a buy limit, and then that's a sell limit. So I'm going to close both orders. I'm going to leave it to hit the stop loss of the buy, but I'll close the sell limit. Delete the order, right? I'll close the sell limit while I show you a sell stop. So I want to set a sell stop now. So that same button. Now a sell stop is a different kind of pending order that you set below price. If you are selling, you set it below price because you want price to get there and continue to sell. Do you understand? Price will get there and continue to sell. So let's say I want to set a sell stop here. I can literally set that, and the stop loss will be above the sell stop, above somewhere, right? And then your take profit will be below because you are selling, obviously. Hold on. So that's the sell stop. So once you click on that right arrow, you can go and place it. So that's the sell stop, and it's been set. So if price was to get below there, right? If price was to get below there, price the order will get triggered and it will begin to sell to the downside. Now I want to set a buy stop now. A buy stop, you set it above current price because you want price to get to that point to start buying instantly. So same button, I'm going to take it up and it's going to start showing me the option for a buy stop, right? So if price was to get to this buy stop, my stop loss, let me put my stop loss below somewhere here. Now remember, always calculate your risk before you set the order, but I'm not calculating because I'm just showing an example. I want to quickly put it before market gets there. So if you were to use a buy stop, you are saying that price should get to this point above current price based on your analysis, and if price should get there, trigger you into the buy, and your stop loss will be somewhere below here, right? And then your take profit off, obviously. So you see that has triggered both of them now. So we're in both buys, and your take profit will be somewhere above the order that you set. Let me put my take profit now. What's happening? So buy stop. Where's my buy stop? And the second one is what I'm talking about. Put my TP above somewhere there. So now I can set it. So you see right now that both my buys are in profit, right? So I can close the sell stop now because based on what I was seeing in the market, I didn't expect it to sell, right? So you can see that even though I'm showing an example, there's still a little bit of like the scale is still showing. You understand? So if, for example, I was trying to actually take a trade in the market, I'll actually be buying. So I want to close the orders now, and so we're out of here. So I'm not going to wait for it to hit the profit because it may or may not, right? So I'm going to like close. Let me see if I can do a bulk operation of close. No, sorry about that. I pressed the wrong button. So close position. Let me see if I can do bulk operation to close all positions. Boom. So we're still in profit basically. Awesome. So now those are all the orders, and so there was still one last one that they call a buy stop, a sell stop limit, and a buy stop limit. So you never use that one, you may never use that order, so there's no point showing you, it might just confuse you. So those are all the orders that you come across, or the ones that you'll be using. And I believe I also did a quick tour of this app, and there's still some options I need to show you. So if you don't want this buy and sell thing to be showing at the top, I told you you can remove it by tapping that, and it should just go away. Oh, okay. Now when you tap on your screen, some of these options are still here, like your crosshair is here, right? When you tap on the screen, you can literally do some settings here. You can don't really, until you really start to get acquainted with the app, don't mess with the settings, just leave it the way it is, right? Then
There's the object, but in case you want to draw on the chart, like do your analysis, I prefer to use an trading view for analysis, while I just use this for executing trades, right? And then time frames are also here. You can switch time frames, and I already explained what time frames are. Each candle represents the time. For example, on the 5 minute time frame, each candle here represents 5 minutes. Same thing on the 15 minutes, and it gives you different views of the market based on different time frames. You understand? And all of this you understand it in the technical analysis video, right? So that's basically everything you need to know here at this point in time. That's basically all of it. So, let me go back to the tasks that I got for you. What my task? Okay, great. So I've explained basically all these things, and hope hold on, hope the voice is loud. Okay, great. Um, so I already explained how to calculate your lot size. That it's simply your risk divided by your pipette or points. Remember, 5 pips equals to 50 pipettes or 50 points, and that's how you calculate your stop loss. I literally calculated one for you right there just now. And then you have different kind of orders: instant execution buy, instant execution sell, then the buy stop, sell stop, buy limit, sell limit, and then the stop loss, and then take profit orders. The stop loss order is if you're wrong, price gets here, take me out of the trade at this particular loss. And take profit is if I'm right, price gets to this point, take me out at this particular profit. Very simple, straight to the point. So now your assignment or your task for this particular video is to write out the definitions of instant execution, the instant execution buy, instant execution sell, then the buy stop, the sell stop, then buy limit, sell limit, stop loss, and take profit. Write out the definitions of all of these kind of orders. Then you write the formula for calculating lot size. Write the formula for calculating lot size. Then you're going to calculate. Right, first of all, write the formula for calculating lot size. Then you are going to use that same formula you just wrote out to calculate this particular with this scenario. So the first one, the person is risking $50 and the stop loss is 20 pips. What will be his lot size? Number two, the person is risking $100 and the stop loss is 100 pips. What will be the lot size? Remember, the formula is risk divided by pipette. So the first one will be 50 divided by 200. Second one will be 100 divided by 1000. So just like that. Third person is risking $3 and the stop loss is 15 pips. Formula is 3 divided by 150, right? Because it's 3 divided by the 150 pipettes, 150 points. The fourth one, the person is risking $5 and the stop loss is 40 pips. What will be the lot size? The fifth is person is risking $10 and the stop loss is 12 pips. What will be his lot size? And then your next question on this particular task is, what is your job as a trader? I've mentioned it in this video. What is your job as a trader? And then next question is, what is an edge? I mentioned it in this video as well. What is an edge? Then the final question on this particular assignment is, what's the formula for calculating edge? What's the formula for calculating edge? So please do your tasks. Remember, only those who complete all my tasks are eligible for my $5,000 evaluation account giveaway or gift whenever I'm doing that. So please endeavor to do all the tasks as quickly as possible, because there's a time limit when you can complete it. So thanks for watching this. See you in the next one.